Interest rates have nearly doubled recently, and our inventory has tripled now too. The market has definitely shifted, all right? So what now? What should you do as a buyer? I'm Jim Fong. I'm an investor and realtor with Urban Nest Realty in Las Vegas. And today I'm going to discuss with you how to adjust and adapt to this new market, because it's totally flipped. It was totally favorable for sellers. Now it's becoming favorable for buyers like you. I brought in a mortgage lender today to help us discuss work out the numbers and everything on how to help you as a buyer save money and reduce your monthly mortgage payment. If you find information like this useful, please be sure to like and subscribe to my channel so you can know when new videos release. Oh, and be sure to check out my other videos about real estate investing. But back to the topic today, saving you money as a buyer. All right, so back to the topic though, all right? So today I'm joined here with Wes Friedman. He's a mortgage loan officer with FBC Mortgage. His contact information will be below in the description. But Wes, what are you excited to tell us about today?
Our goal is to show you how to save money. And we're talking a couple $100 monthly, thousands over the course of your loan with an inflation buster program. I guess I can term it that way.
Okay, awesome. Can't wait to hear about it. But first of all, like you said, interest rates went down so much recently, right? Just to give us some type of reference point, what are interest rates looking like today, like a ballpark figure?
You're going to be in the high fives, low sixes, depending on down payment and credit scores. It's driven by that. But
okay. That sounds so high to me. So tell me, where were we at earlier this year?
Earlier this year, your high twos, your low threes was a normal type of interest rate depending on the program. And so we've seen it dramatically change in a short period of time.
Yeah, so we're seeing rates like around 3, now they're around 6, right? So yes. It really, truly has doubled, right? I've had buyers that I was working with before, and now they're holding off and waiting now, or they don't qualify anymore. So do you have buyers that you have qualified before and now they don't qualify anymore?
Yeah, unfortunately, Jim, I would say we lost 50% of our pipeline. It's because of the high rates and the payment shock. You could have been in a market at 3.25 versus what we are today, and you're going to find your payments probably $8, depending on price, of course, but a couple $100, $300-$400 more than what it was.
A lot more than that. Yeah, so that's interesting. So you would say that half of your qualified buyers are no longer looking, they're just kind of not returning your call anymore?
The affordability's changed dramatically for them, and they are basically either sitting on the sidelines some to watch the market and see where rates go, because it happens so fast, so quick.
Okay, so that goes along for me and other people in the industry as well too, is that that were looking for homes that are now kind of putting a pause on that just because interest rates are so high right now. Even on listings I have, instead of 10 to 20 offers in the first weekend I put the house on the market, we're happy to have showings, really, right? We've lost a lot of our buyers, We're not seeing people bidding over list price, offering free rent backs, waiving appraisal contingencies. Like, these are all very favorable seller terms.
Absolutely.
And those are all kind of going away right now.
And I'm excited to see it change for buyers. They've been getting the short end of the stick for the last 2.5 years. Like you said, paying over appraised value. Mind you, the interest rates were good, but they just weren't getting seller contributions towards closing costs. So we're seeing that change.
So Wes, what are the two main things when someone comes to you and applies for a mortgage? What are like two of their biggest concerns?
First is the money out of pocket, what they have to bring to the table. And that can include your down payment, your closing costs, your home inspections, your appraisal.
And earnest money even sometimes, right? For me, when I'm working with buyers, a lot of times they have to borrow money from like their parents, right?
And we're finding like our first-time home buyers right now do have to lean on parents. They may have a 401k that they can draw off of to come up with the funds needed to close.
That's very true. A lot of times when I talk to people that just start the process, that's almost their first question. How much money do I need to come up with, right? So that's number one.
And then naturally, the second question.
Second question is what?
Payment. Most important, in my opinion, because you got a budget, especially in these inflationary times.
Okay, and that's where interest rate comes in so much, right? Because your interest rate is going to be directly correlated to what your payment is going to be.
Exactly.
Right now, right? And with it going up so high, payments have gone up a lot, okay? So with clients that we've worked with more recently in this new market now, we've been negotiating for closing costs. So we're basically having the sellers give credits to our buyers, all right? And this has helped a lot of our buyers, because some buyers, they have their down payment and everything, but there's moving costs involved, all right? This helps them with that. Or sometimes, they want to do some initial renovations before they move in, all right? So we get a credit for you. That's less money they have to put on their down payment, which leaves cash in their pockets, and now they can paint, get that new flooring, get the new appliances and furniture and things like that, all right? But let's say closing costs and down payments are not your issue. Maybe you just don't like that you're paying such a higher payment now that the interest rates have doubled, right? Earlier this year, your payment would have been this much. Now it's this much, all right? You just want to keep your payment lower, all right? So what else can we do about this, all right? And again, if you're finding this topic helpful to you right now, be sure to like and subscribe to the channel. There's a lot of great information on there, and you'll be notified when new videos like this are released, okay? But back to this, all right? So what else can we possibly do with a seller credit to our buyer, Wes? What would you suggest to a borrower?
Good question, Jim. So our clients in the last 2.5 years, because it being a seller-dominated market, were customary, and it was normal for them to bring in their down payment and closing costs without the seller paying anything. Well, now because of the change, the seller, if they give you money, we can allocate some of those funds to do what's called an interest rate buy-down.
Interest rate buy-down. Can you explain to me what an interest rate buy-down is?
Yes, you bet. So it takes the prevailing rate for the day, what is called the par rate, and allows a consumer to pay additional funds to buy the loan amount down under the par rate. And so it was more common for people that just couldn't income qualify with the day's rate. They had to buy down the rate to make it qualify. That's how it originally started. Now we're doing it to make these rates more attractive and home affordability more.
So what you're saying is, if I can just pay like this upfront fee, I can make my rate that I qualify for. We can go even lower than that, right?
No question about it.
Okay.
In some cases, pretty extreme.
Okay, cool. So, I mean, how much would a rate buy down? Give me an example of a rate buy down. What would it cost?
It varies. I mean, usually you can pay 1%, 2%, 3%, 2.5%. It all changes. So what we do is when we're negotiating with these sellers, we're going to try to demand the most. And typically, prior to this market change, 3% was the common amount of a seller contribution towards closing costs.
That is true. That is true. I mean, in many years past, before it was such a seller market, I mean, 3% closing costs was a very common thing. I mean, in traditional or the resale market, or with builders too. I mean, builders were often giving 3% credits for people like that too. So
now let's take that money and use it either for our closing costs, like you had mentioned.
Okay, cool.
Lighten the load a little bit, or let's take all that money and buy down the rate and still pay our closing costs and down payment separately from that.
So can you give us a couple examples of that? Like, what if somebody qualified for 400,000 FHA or something like that? Give me an example of how you would use 3% as a buy down.
Well, so on 400,000, we're talking about $12,000 that we can buy down the interest rate, which is quite a bit.
Right.
And so now we're taking you from, let's say today's rate's at 6.25, hypothetically. We use a buy down of 3%. We're going to drop your interest rate over 1.125%, so over a point, which equates to about $300 a month in savings.
Wow. Okay, so $300 less on a payment. I mean, that's pretty substantial, especially when we're talking about a $400K house, right? So, and you're saying that will cost $12,000, right?
Correct.
So,
given by the seller.
Okay.
Of course.
So let's just say we don't take it as a credit. What if we just reduce the sale price by $12,000?
Great question.
What is the savings for a buyer at that point?
Not much at all. So if they drop $12,000 on the sales price, which is nice, okay, because you're getting it discounted, and sellers are motivated to drop price, but let's not do that. Let's take that money to buy down the rate, because that saves you $80 a month. So $12,000 less price is only $80 a month on a $400,000 purchase.
Okay, so you're saying, so like a rate buy down, if I use $12,000, if I can get the seller to pay $12,000 in closing costs for me, and I use it towards a rate buy down, my payment's going to be $300 less. Whereas if I just reduced the sale price and the principal balance went down $12,000, that's only going to save me $80. All right, so this is just a strategy to help you as like a buyer to save money on your monthly payment.
thousands of dollars over the life of the loan.
And what are we calling this, Wes?
The inflation buster.
All right.
We're going to make sure those groceries are less expensive by saving you money on your monthly payment.
So to sellers, that credit is all the same to them, all right? They credit you in this way. They're still minusing $12,000 either way, all right? But to you as a buyer and a borrower, how you structure it is very important, okay? So we know the market has changed, all right? You need to work with an agent that knows how to negotiate in our current market and not just what was working last year, okay? So thanks for watching our video. Be sure to check out the other ones on our channel too. Thanks.